Hello, Uncle Jim here. One of the greatest ways to make passive income is by selling options. And when you pair that with dividends, you can really do well. Today, I want to share with you two securities that have worked out really well for me. I'm going to share details about them, how I've invested in them, and how I've actually sold options on them. So stay tuned. I think you're going to enjoy what I have for you. Okay, let's go ahead and jump in. I typically like to do a quick market update at the beginning of most of my videos, and I'm going to keep it really brief this time. It's been a rough September. The market has been down. It's down today. It was down yesterday and Tuesday. And I believe we're going through a consolidation. I don't think we're switching into a bear market. I do think there's some good indicators and some bad indicators. I still think the Fed's going to hold steady. I don't think they're going to increase rates or decrease rates anytime soon. I believe the consensus is they may even bring rates down early next year, maybe January, February, March, in that time frame. So overall, I think it's not a time to panic. I know the market's been kind of tough this week, but the worst thing you could do is to sell when some of these stocks are down. Now, if you eliminate the six big boys, if you eliminate Nvidia, Apple, Google, Microsoft, Amazon, and Meta, I believe the market's flat or maybe slightly down for the year. So, and those are some of the big names I think are the ones who are consolidating. Like I said before, I know Apple is, but I think also Microsoft's down today, and maybe even Google may be down a little bit. So at least that's what I'm thinking. And, again, it may only be worth 2 cents, so you can take it or leave it. But I'm choosing not to panic. I still think it's a good opportunity to sell some puts and to pick up some good names at good prices. And two of those names I'm going to talk about in this video and share with you two of my favorite securities to trade. I'm going to actually go through my trades and share with you how I decide to pick these particular companies. And so that kind of leads us to the next part of this video. I've always been a dividend investor going back. I've been investing since the late 80s. As soon as I got out of college in 88, I started investing. And I didn't get into options till about 12 years ago, but it really gives an income portfolio that much more of a kick, that the ability to make even more income than just dividends. So for me, I typically look for value companies who pay dividends, that are not just paying dividends, I'm not just chasing dividends, but also growing dividends, and companies that have low PEs, they don't have PEs way above what the standard is for that industry. And then also don't have a lot of debt, especially with the interest rates going up. Companies with a lot of debt are definitely more impacted than the companies that don't have debt. One of the companies I'm going to talk about today literally has no debt, and it pays dividends, and it's growing dividends. And there's very few companies like that. So what I typically like to do, at first I would just buy dividend-based companies, but now I actually use what's called the wheel, and I sell puts on stocks that I want to own. And I typically use pricing that's cheaper. Now, a lot of people who sell options will do it on a weekly or monthly basis. I go a little farther out so that I can pick up these special names or these good securities at cheaper prices. Let me just give you an example. So say you're looking at somebody like Cisco, and let's just say it's 60. I believe it may be as high as almost 67 or 68, but let's just say, for example purpose, that it's $60. Now, if I do a 1 week put, or a put that expires in 1 week, the strike price may be 57 or 58. So I'm taking a lot more risk. The chance that Cisco could go down to 57 or 58 is pretty high. Now, if I decide, well, I'd rather do a month, so I'll look at a month expiration. Well, I could probably sell that Cisco put for like $55, so a $55 strike, which typically coincides with what I call, or not I call, but everyone calls delta, and it's one of the Greeks. And if you're looking around a 15, a high 15 delta, that's usually about a 10% discount. So $55 for Cisco when it's 60 is pretty close to a 10% discount. Now, if I go out 2 or 3 months, the price comes even lower. So I can potentially look at selling puts on Cisco at like $50, which is usually or typically really close to the 52-week low. And it's a lot less risky. Now, I do give up some returns, but in most cases, I don't hold that put for the whole time. So say it's going to expire in 90 days. A lot of times I'm closing it or rolling it 3 weeks before that. So it may be more like 60 days when you actually look at the the history of the options that I've sold on these securities. And so I give up some of the return, but I typically limit the risk big time. So I don't make quite as much money as potentially you could, but I found that when I did the shorter time spans, I ended up getting myself in trouble more often. And, I might do really well for a period of time, but then things would change. So by selling these puts repetitively, and then at some point, it would get assigned to me, and that's happened quite a bit, I'm actually picking up the stock at a lower price, just the nature of a put, because again, let's use that Cisco example. If it's $60 and I'm selling a $55 put and it does get assigned to me just by the nature of picking that stock up at 55, I'm still better than if I had bought it at 60 when I was first looking at it. So I find it works out well for me. And then I keep doing that until it does get assigned. And when it gets assigned to me, it typically has a lower cost basis. And then I can pretty much do it again. I've been able to accumulate quite a few. I think I've got close to 600 shares in Corning. I think I have 400 shares in Cisco. And this has given me the ability to do that. Now, I also talk about what's called happy assignment. And that's pretty much what I'm meaning. If I had bought Cisco at 60 originally and not sold the put, so I would have paid a lot more for it. So in a way, it's a happy assignment because it's being assigned to me at 55 plus whatever premium I picked up. So it's actually a little bit low, 55. It's worked out well, and I've picked up a stock at a great price that'll grow. And in this example with Cisco, since the last couple hundred shares that were assigned to me, I believe it's up 20-30% over what it was when it was assigned to me. So that's kind of why I like to call it happy assignment, because you got to remember, if you had bought the stock originally when you were first looking at the put, you would have paid more. So just the nature of selling puts causes you to get prices at a lower price or a better price. And it's really hard to time the market. So, I can never get the bottom. Some people might be able to, and you can if you have some extra cash. But again, you never really know when the bottom is. And then once you own it, again, I'll use the example of Cisco. Once you own it, then you can turn around and start selling what's called covered calls. And they're called covered calls because you already own the stock, and you can sell not call puts or covered calls on those particular shares. So since I have 400 shares of Cisco, I can sell 4 covered calls, and typically that's what I'll do. And I typically will spread out the expiration. So if I have 400 shares, I may have one contract that expires in 30 days, another contract that expires in 60 and maybe 90. And then I'll take one expiration, and I may go like a year and a half out and do what's called a leap and pick up some really good premiums. So if you did a leap on Cisco on a really high premium day, you could maybe bring in $400, $500, $600 on doing this much farther out leap. Now you might say, well, then you're tying your money up for a year and a half. But remember, as Cisco goes up and down, so does these long-term leaps. So, say you sell a leap that's not expiring till January 25, if Cisco drops for whatever reason, maybe they have bad earnings and suddenly they're in the low 50s again, then those leaps will become very profitable very quickly. And that's what I've seen. I've been doing this for many years with Coca-Cola, and this is what, when I first started, that's all I did. I just sold short-term and long-term covered calls on Coca-Cola. And just in the last 2 weeks, Coke has dropped, and I've been able to close, I think, 9 different Coke contracts, and a good number of them were leaps originally. So just keep that in mind. And then what happens is, so you first, sold a put, and you did that several times, picked up some income, then you were assigned, then you sold a call, and then depending on how much risk you want to take, I typically don't want to ever let my stocks get assigned away, but some people may be okay with them being assigned away. So you might want to take more risk and earn more premium with your calls, and then if it gets assigned away, then you can start all over again and you have that cash, which works out really well. It can generate a lot of cash to grow your account. And that's typically what I've been doing. And another test that I did recently, and I'll probably do a future video on it, I have a 401k with Fidelity, and I compared its returns for the last 2 years compared to what I call my IRA with options. That's where I'm doing most of my puts and this kind of trading. And I did significantly better over those 2 years in my IRA with options compared to my 401k in Fidelity. And I'm actually looking to move that 401k in Fidelity because it's an old 401k. I kept it there because I did like what I could invest in at Fidelity. But again, the performance I did so much better. I'm going to look at actually moving that into an IRA, probably keep it at Fidelity and then start selling options on it too, just like I have with my other IRAs. So I just wanted to share that. I probably, like I said, will do a future video on that. But that's the main pieces I wanted to cover. Next, we'll go into a little bit more detail. I'll share with you my trades. I'll also share how I decided to invest in these particular companies, or most of the companies that I deal with. And as always, please subscribe, hit that like button. If you're curious about my memberships, take a look below. I'll have details in the description. And my memberships are growing. I'm definitely getting a lot busier. My Discord, it seems like there's lots of activity in there now. So with that being said, let's jump into the next part of the video. Okay, now I've opened up Schwab, and I'm going to share with you the research area within Schwab. It does a really nice job for you to evaluate certain stocks. So I'm going to start with one of my favorite ETFs. It's probably second to SCHD, but it's mainly in the energy sector. It's XLE. Here you can see it's got good ratings by Morningstar. It's on Schwab, it shows you the 52-week range. It gives you some nice charting. It doesn't just share Morningstar, but it's got more details. It talks about market edge, how to look at it. It breaks down, what the expense ratio is, what kind of returns it has, what type of stocks it carries. And it goes into a lot of detail. You can also look at the holdings. I really like how one great area to look if you're looking for some stocks is to look at some of your favorite ETFs and look at their holdings. You could potentially find some good opportunities. So XLE carries most of the big name energy companies. Here you got ExxonMobil, you've got ConocoPhillips, you've got Occidental Petroleum, Marathon Petroleum. You've got a pretty good selection here to choose from. And then you can also see the distributions. It pays like 3.5%, and it increases those distributions. As the companies increase them, it also increases its distributions, again, because it's based on the underlying holdings. Now, I also like to look at Seeking Alpha, and here, if we look at Seeking Alpha at XLE, and it also has a nice chart. This is the part I really like. It'll give it a score. Here they're saying it's a buy rating with a 4.0 score, and in quant also gives it a really good score. And then underneath you've got analysis. These are different people on Seeking Alpha that are using it and leaving details, and I find the comments really helpful. So I'll go through and I'll read a lot of these articles. And then here you've got the latest news. Now I use that also to, to jump into and look at in more detail. Like here we see it's oil jumps to a 10-month high. So that's partially why XLE has done so well. One other thing that's really interesting about Seeking Alpha, it does have this top stocks, and it'll rate the different stocks. So this is another area I'll look. You could see it's got quant SA analysts in Wall Street, so you can see who they're suggesting are some of the best names to look at. And you've got dividends, you've got the size, and same thing with top ETFs. So they'll have information here. So I found this very helpful, and it works out quite nice. So between these two, between Seeking Alpha and the stuff on, let me move this out of the way, on Schwab, makes it really nice to work with. So let's go back to Schwab. So XLE is like I said, been really good ETF for me. I'll share my trades at the very end of this video. Well, I'll go over the trades I've done in XLE. But next, let's jump into Williams-Sonoma. And Williams-Sonoma is an amazing company. You can see it's highly rated by Schwab. And right now it's around 143. It's not at its high, but it's also not near its low. It seems to jump around quite a bit. Like right now it's at 143, but I think within a week ago, yeah, you can see here it was in the high 130s. But it seems to dip back down, and then it's a good time to sell some more puts. And I've been able to sell puts on a regular basis with it. If it's probably one of my best performers. But what I really like is if you come down here, also it's got news here, just like some of the similar to Seeking Alpha, but the latest news. And here you can see the dividends. It increased from 79 to 90 cents in dividends. And you can expand it, and you can see it's doing really well dividend-wise. It's increased most years. Schwab does a nice job with this. So you've got all sorts of dividend information. You've got the annual dividend yield. It also talks about what the next ex-dividend date would be, when they're going to actually pay that dividend. So quite a bit of detail. Also talks about payout ratio, which is really low. So they got plenty of cash to pay these dividends. And you can see 10-year growth rate, 13%, 13.2. 5-year, 14.9, 3-year, 17.1. So they're increasing their dividends, not decreasing, which is pretty impressive. So if we close this and then we look at their earnings, they've done quite well. Every quarter they've beaten earnings. So good company, well managed. And what's really impressive with me, if you look down here, total debt, no debt. So they're literally paying dividends, increasing dividends, and to have no debt and be able to do that is truly amazing. And then if you come and look at them over here on Seeking Alpha, you can see it's rated a buy, and again some good analysis that you can jump in and read about. I won't go into detail about it, but the comments are always pretty interesting too, to what people think. And it's interesting, it's a lot of the people on Seeking Alpha like them, but Wall Street not so much, which I don't quite understand. They seem to like companies that make no money and won't make any money in a long time, but and then don't like Williams-Sonoma. I don't quite get it. So that's the two companies. The next part of the video will actually jump in and take a look at my trade. So stay tuned. Let's jump into the next section. Okay, so here's XLE, and I've started trading it 12/16/2022, so about 9 months ago, I guess. Yeah, almost exactly 9 months. And so here I did my first trade. I brought in some pretty good premium, and then the next trade I did was in January 23rd. And so you can see here it was 3/17/23 was the expiration on my first trade. And my next one, which I closed, so I closed it early. I closed it January 23rd. So I closed it way before the expiration. And this is probably one of my weaknesses. I probably should do this more often, but I get busy and I jump on different things and I forget to close them. But in this case, I did close it. And then on the 30th, I opened a new position and brought in almost $200, a little bit less than $200. Again, that's what I like to shoot for. I try to earn 200 on each trade. So this was the first one. The second was close. Here's the third trade. And then it was expiring on March 31st. And each time these were pretty, I believe we're right around a 15 delta. At one point, XLE did drop and I did lower it, and you'll see that here in a minute. So my third trade was March 27th, and I did it a little bit higher, a 79 put, 79.69, and all these were vertical credit spreads. First I did 70.60, 70.60. I went up higher, so I took a little bit more risk. I believe it went way up, and then I thought, well, I'll take a little bit more risk because I want to own it. And then I did lower it a little bit, still picked up good premium. I think we can select all four and look what the premium. So 180, that's what the premium was for this, and it was expiring on 3/31. And actually, that was the close. That's when it was supposed to expire. So this one I closed maybe 9 days early. And then I opened one for 6/16, and 10 days early, I ended up closing it and rolling again. So this time I actually lowered it a little bit. I went from 79.69 to 78.68. And I brought in at that time 204.72. So again, two contracts, tried to pick up 100 per contract, or right around $200 for each trade. And then on 7/27, so a little, again, probably almost 2 weeks before expiration, I closed it. So 7/27, I believe that's maybe almost closer to 3 weeks before expiration. And I opened some new ones. Actually, these were the 8/18s I closed, and here I rolled. And I opened some new ones that would be expiring on 12/15, and these are currently open. And these, again, I went down when I rolled. So I went from 80.70 to 79.69, and 78 to 77, and then 77 to 67. And these are quite a bit out of the money. So for this trade, what did I do? 184. And like I said, these are very outside the money. You saw it was 91 currently, so it's almost $14 out of the money. And then overall, I've done $916. So, and this were for two $10 spread contracts. So the required capital is, $2,000. So in a way, I've made really close to a 50, pretty close to 50%. In the year. It's not even a year. I should be able to do one more trade. So I guess a little bit less than a year, 9 months. So really good return with XLE. And it's hard to find these kind of returns with very many ETFs, but it's worked out quite well for me. And again, you can see I currently don't own XLE. So all of these, pretty much, I was able to roll, and like I said, I did have one that I closed. So that's XLE. Let's jump into the next one. This is actually Williams-Sonoma, and it looks similar. I started this in 1/3/23, so my first trade with them was 1/3/23. I did it a little over, I guess, what was that, a month and a half, so 6 weeks or so. And I picked up for that trade 225, and then I closed, buy to close, sell to close. So I also closed this one. I spent $35 to close, and then literally about a week later, I opened a new position. So that's something else to take from this video is that's really a roll. It's just I delayed a week. Remember, rolling is just closing your current position and opening a new one, and you don't have to do it in one seamless trade. You can do one, you can close it and then open another one. And a lot of times you can make more by doing that. And like I said before, that's one of the areas I definitely could do better. If I close these more often and open new positions more often, I could probably do a bit better. So this one would be expiring 5/19. I closed it on 5/3, so I'm a little more than 2 weeks before expiration, and I opened a new position that would expire 6/16. So a little bit more than a month away. And let's see how I did on that one. I did 208. You can see the sum down here, 208. And then I let that one expire. So on 6/20, it expired. So I did let it expire. Again, I probably could have closed it because it's almost always fairly significantly out of the money. So then I opened a new position, and what did I bring in for that one? 149. That was a little bit lower than most of my trades, and that was for 8/18, 8/15. So a couple days before I did close it, and I opened a new position in 11/17. And for the most part, I started out doing a 95/85, then went to 110, 100, because it kind of shot up. Then I did 110, 100, 110, 100, 110, 100. Then I went down to 105.95. And then 110.95. Not sure why I did that. 8/18. This is a new one. So I did 105.95. So I kind of moved around. I mean, only about $10. It looks like the highest was 110. Yeah, 100 versus 110, and 95 versus 105. So for this trade, let's see how I did. I did 270, and then so I did 1, 2, 3. That's really one trade. 4, 5. So 5 trades, I made 1,142. So a little bit better than, quite a bit better than 200 a trade, and made 1,142 in less than a year, in only 9 months. So first trade was 1.3, and it's what, 9.97 currently. So in 9 months, so this is probably one of my best performing option trades that I've done. And like I said, I've done it repeatedly, and I've gone a little farther out. And maybe I should take more risk and let this get assigned or bring in more premium, because I definitely want to own it. If it gets anywhere near this 110, 115 range, I probably will. I'd be curious to what your thoughts are. Add a comment below. Should I take more risk and go ahead and let it get assigned to me? I try to answer almost all my comments. So, give me 24, 48 hours, and I typically will get to it. So that's it. Those are the two securities that I wanted to talk about. So, and they've worked out really well for me. And then both of these are in my what I like to call my IRA with options. And this is the same one that I compared with my 401k, which I have at Fidelity, and I've done much better in this account than I have in Fidelity. So that's it. As always, hope you enjoyed this, and look forward to seeing you again in the next one. Thank you.